All right, before we jump in, just a quick reminder. This is all for fun, for education, definitely not financial advice. Honestly, it's probably best to think of the market as a giant casino. And as we're about to see, sometimes the house doesn't always win. Okay, let's get to it.
You know, this quote really nails it. The whole GameStop saga wasn't just about some stock going crazy. Nope, it was the first real battle in a totally new kind of war. It was the moment that thousands of everyday people found a glitch in the simulation of Wall Street and decided to see what would happen if they pushed the button.
So, to really get what happened, we've got to play detective here. Our first stop, the scene of the crime. We're talking about a struggling video game store, GameStop, and the wild vulnerability that a bunch of Redditors who call themselves Apes somehow managed to uncover.
At the very center of all this is something called short selling. Basically, you had these giant hedge funds placing huge bets that GameStop was going to die. They were borrowing shares, selling them, and just waiting for the price to crater so they could buy them back for pennies on the dollar and pocket the difference. But a whole community of online investors did the math and realized that the so-called smart money had gotten way, way too greedy.
And this was their weapon, the short squeeze. Think about it. If you're betting a stock will go down, what on earth do you do if it goes up instead? Well, you have to buy back those shares you borrowed, only now they're way more expensive. So when thousands of retail folks started buying, the price went up, which forced the short sellers to buy, which, you guessed it, forced the price up even more. It's this insane feedback loop that gets very, very expensive for the people on the wrong side of the bet.
And just how expensive did it get? Well, according to Wikipedia, in January 2021 alone, short sellers lost a mind-boggling $6 billion. This wasn't just a little oopsie. This was a catastrophic, system-shaking failure for some of the biggest names on Wall Street, and it all happened because they completely underestimated a Reddit forum.
What's truly wild is just how fast this all went down. I mean, look at this timeline. The price goes from around $4 to over $80 in a single week. This wasn't a slow build. It was a straight-up explosion, and it was fueled by memes, social media, and of course, that now legendary tweet from Elon Musk. This is what finance looks like at the speed of the internet.
But if you ask the folks on the Superstong subreddit, the real glitch goes way deeper. It's all about who actually owns your shares. See, most of us have what's called beneficial ownership. This means your shares are technically in your broker's name, held in this big central vault. The ape theory says this system creates something they call infinite liquidity, which is a nice way of saying shares can be lent out again and again and again. Their answer? Direct registration, or DRS. This puts the shares directly in your name, yanking them out of the system entirely so they can't be borrowed by short sellers. For them, it's the ultimate checkmate.
So let's zoom out a bit, because this whole glitch thing, it didn't just stop with one stock. The idea started to spread, and it proved that the force that was unleashed here wasn't just about GameStop. It was about a massive shift in how the entire market operates.
So you've got to be asking yourself, right? Was this just some weird one-off internet thing? A crazy fluke that could never, ever happen again?
Oh no, not even close. This timeline here, it's from a 2023 academic study on the collapse of Silicon Valley Bank. And what it shows is that the exact same weapon, super fast, widespread communication on social media, was a major catalyst in the 2023 regional banking crisis. It was, for all intents and purposes, a digital bank run, playing out in real time on all our phones.
And here's the proof in the pudding. Researchers actually found that during the SVB crisis, banks that were getting talked about a lot on Twitter suffered an extra 6.6% stock market loss compared to banks that were flying under the radar. So the big takeaway here is that social media chatter isn't just noise anymore. It is a real, measurable market force that comes with a hefty price tag.
The study's conclusions are pretty chilling, actually. Social media takes any existing problem a bank has and shoves it under a giant magnifying glass. A high volume of tweets was a direct predictor of stock losses, hour by hour. And when those tweets had negative words or keywords like contagion, the damage was even worse. We're at a point where memes can literally start a bank run. Wild.
Okay, so we've got retail investors with memes battling hedge funds. But while that fight is going on, there is a much, much bigger force that is quietly redesigning the entire board.
And this is where our story takes a really sharp turn. Because as captivating as this whole Apes versus Suits drama is, it's rapidly becoming a sideshow. The real war for the future of the market isn't being fought on Reddit.
The new kingmaker in all of this is a name I'm sure you know, Nvidia. According to their CEO, Jensen Huang, the basic rule that powered computing for half a century, Moore's Law, it's over. Done. The old engines, CPUs, are getting swapped out for powerful new ones, GPUs. And this isn't just some techie upgrade, it's a fundamental change in how everything works.
So what's at stake here? Huang is predicting that Nvidia's tech is going to replace the entire $1 trillion market for the data centers that run on old CPUs. We're not just talking about building faster computers, we are talking about rebuilding the entire digital skeleton that the global economy stands on.
And this digital revolution has a very real, very physical cost. A recent Goldman Sachs report is forecasting that by 2030, the amount of electricity we need for data centers is going to grow by over 175%. The AI revolution literally runs on power, and its incredible thirst for it is already reshaping everything from energy markets to global politics.
So how does the establishment, the suits over at places like Goldman Sachs, see this crazy new world? Well, their own map of the future looks just as chaotic as everyone else's, but they're focused on a completely different set of glitches.
This is right from Goldman's investment outlook, and the title just says it all: Seeking Catalysts Amid Complexity. They know the old playbook is out the window. They see a world that's breaking apart, full of risk, but they're not trying to burn it down, they're trying to figure out how to profit from the chaos.
And the stuff that's keeping them up at night? It's global. They're looking at trade wars, with U.S. tariffs at levels we haven't seen since the Great Depression. They're looking at staggering government deficits. And they're looking at actual real wars, which are forcing huge new waves of defense spending. For them, these are the variables that are driving the machine now.
Which brings us right to the heart of it all. We now have two completely different theories about how the world works. Two groups staring at the exact same machine, but seeing two totally different games being played. So on one side, you've got the official narrative from Goldman. They see this super complex world, and their job is to navigate all the risks, tariffs, AI, geopolitics, to find a way to make money. But on the other side, you've got the ape theory. They believe the system itself is the risk. They see a rigged game, a ticking time bomb of so-called infinite liquidity, and they are focused on one move: direct registration as the pin to pull on the whole grenade.
So what's the bottom line here? What should you take away from all this? Well, it's that the rules of the game have been completely rewritten. Social media isn't just talk anymore, it's a systemic force. The physical world of supply chains and geopolitics matters more than ever, and the unstoppable demand for power from AI is creating a new commodity that's every bit as important as oil ever was. Understanding these new rules is really the only way to make sense of the market today.
And that leaves us with one final, big question. In a market that is this complicated, this chaotic, and this full of glitches, who's writing the code for the next crash? Is it the hedge funds, the apes, the AI developers, the politicians? The truth is, nobody knows. But one thing seems pretty clear. The machine is a lot more fragile than any of us ever thought. Thanks for watching.